200 points as we count down to the closing bell. We want to bring up Ted Oakley of Oxbow Advisors Managing Partner there. Ted, let me start with you just in terms of the market's reaction. The market's up today despite that weaker than expected job report. How do you think the market is viewing the slowing growth that we saw in the month of November?
Well, Seana, I think what we've had right now is a momentum push. When you go up every day and you keep on going up, nobody wants to do anything about that. And to me, it's just more of a momentum play right here. I don't know when that finishes out, but I don't see that as some reaction to something that's going on in the economy right now.
Jared, taking a look at the market and what we're seeing today, investors seeming to look past any of the weakness that we're seeing in the economy with all three of the major averages here on track for a record.
Yeah, and you have to wonder if the market is actually pricing in more stimulus possibilities based on that headline number that missed this morning on the payroll side. But we're looking at some decent gains for the week. The S&P 500 here, looking at the Wi-Fi Interactive, that is up 1.6%. NASDAQ up the most here, 2%, and the Dow up about 1%. But really, the Russell 2000 has been the story of the week. Again, that's up about 2% as well. And here's the closing bell on Wall Street.
All right, there you have it. We're watching markets settle, and the Dow is going to be positive by over 200 points. The S&P 500 will settle up above 30 points, and the NASDAQ looks like it's going to settle above 80 points. Also want to let you know, small cap still on the rise, going to settle up over 2% today as we finish the trading session and the first trading week in December.
Well, I want to ask about the bond market, and in general, we have the 10-year reaching the highest level since pre-COVID, and we're also seeing the yield curve expand. The 2s10s is reaching the highest level that it's been in about 3 years now. So I'm just wondering where we stand within the fixed, what that's potentially saying about the broader market here.
Ted, do you want to take that?
Here's where I think we are. We really have cut back on our long bonds somewhat. Not a lot, by the way, because when you talk about inflation going up, let's try to get a number here. And I'm thinking, that let's say you go back to 2 or 2.5%. I've been in the business a long time, but 20 years ago, that would have been a fantastic rate. So people get sort of confused on where you're coming from. So you'll go from, maybe a rate that's less than 1 to 2.5. Yeah, that's a big move. Maybe you take your 10-year to 1.25, 1.5. But when you think about it, even though that's a huge move from the 0.5 point we had back in midsummer, that's still not something that probably would thwart everything. It doesn't necessarily mean you get a market crash out of that just because those rates pop back up.
I want to continue what you just said about the 10-year, because it looks like we could very well next week possibly be back above 100 basis points on the 10-year. And we've had guests come on and say it's no big deal. You just said, if I heard correctly, that don't expect a sell-off in equities if that should happen. Is there a threshold at which point people would say, I need to rotate back perhaps out of equities?
Well, I think what would happen on that side of things is that equities would fall on their own. I don't think it would necessarily be because the 10-year, it went back to 1.25, 1.5. On the contrary side of that, I think equities are extremely priced. Relative, I think they priced in every piece of good news. Whatever we think about the vaccine or anything, I think they priced the whole thing in for 21. Because look at the CAPE ratio here, back at an all-time high. And so those are two different things to me to answer that question. But on the bond side, I don't think moving to 1.25, 1.5 would crack the market. But I do think what would crack the market is people eventually realize that, hey, we're very, very fully priced.
Jared, taking a look at some of these record closing highs that we're seeing in the market, a lot of times when we focus on the NASDAQ or the rally in technology, we focus on those big tech names, but semiconductors have really been an outperformer here recently with the SOX, the semiconductor here ETF, closing at another record high today.
Yeah, and the semiconductor industry group as a whole has just been really strong throughout the entire rally since March. Doesn't really get the banners all the time in the headlines, but you take a look at some of the stocks reaching record highs today. Qualcomm up another 5%. That's at a record high. Micron not yet eclipsing its 1999 highs, but up 41% this month. And then you have ADI, Analog Devices. That's a record high, 14% for the month. Overall, it's been a really big contributor to the tech gains that we've seen. But that's not it. We've also seen some big gains in some of the hot money areas like pot stocks. So cannabis, here's what's happened today, but let's do over a 5-day period and sort by performance. We had that landmark bill pass the House today, probably not going to pass the Senate anytime soon, but seeing a lot of growth here, and especially in some of these smaller Canadian names that people might not be familiar with. And then just checking the sector leadership overall for the week, we can see that energy is the big gainer here, followed by healthcare, then tech, communication services. The only downside was in utilities and discretionary. All in all, we have market internals flashing pretty strong here. We're getting record highs in a lot of the internal measurements like the New York Stock Exchange advanced decline line. So momentum is definitely to the upside, and that tends to carry through the end of the month into early January. What happens from there? Anybody's guess.
Ted, when Jared just mentioned energy as a big winner, I was curious what we've seen in the price of oil going up globally. Is that a reflection of a weaker dollar, or is there real demand out there as the global economy might be recovering from this pandemic?
I think, and what you're seeing is, and you notice this when the large public companies started buying other energy companies. I think what they were looking at is that you got to a point to where you could buy people as opposed to drilling up for energy, and that's really what happened. But the supply demand situation, I think it's looking ahead about 6 months. And we own energy, we own pipelines, we own some energy companies, and we felt like all along that they had sold them too much. They had really riddled this group all year long, and the idea that we were going to have some sort of EV situation the next 5 years where you didn't need energy at all was really far-fetched. And I think that it's working its way back in now. But we're high on energy now still. We have been and still are for the first quarter. But I don't think it's necessarily the dollar doesn't help you. You've got a point. But I think it's other things as well. I think you're starting to see people drive more. They're getting out. All of a sudden, things are moving around a little bit. And I think that's important.
All right, Ted Oakley, always great to have you.